Let's talk some more about what we learned this week with David Neuhauser. He's a managing director at Livermore Partners. David, we got to talk some gold to kick it off. I know as we've been discussing, you said maybe there could be some more downside, that we might have to wait for the real inflation to materialize, but this is a lot of downside, David. What's going on here? When's it going to spring back to life?
Well, gold, as you know, has been in a downtrend now since the bottom of yields here in the past 4 months, right? So If you look at gold, it kind of made its high around 2,100 back when the 10-year was making fresh low highs and the yield was at lows. So the question is now you're seeing some backing and filling in gold, and gold obviously has an inverse relationship with rates. So as you've seen rates rise, Oliver, obviously you're seeing gold kind of pair itself and come back into that, mid, $1,500 to $1,800 range. And I think it's going to stay there for some time until you get more information in terms of either yields rise substantially from here or, yields start to settle in.
Okay, so if we're looking at the current trend, higher yields, then maybe gold's still under pressure. But what if those higher yields are moving and inflation starts hitting? And what if we actually start getting some hot numbers? Because right now it's all about expectations and speculation. A lot of people saying the bond yield move is overdone too, that it's all about speculation. What happens is when we actually get inflation that arrives? What do you think the dynamics are going to look like, David?
Well, personally, I think the inflation's already here. Everyone talks about where it's coming. I mean, I think you go to the grocery store, you go fill up your pump, obviously in the next few weeks, and you're going to see that inflation is really here. I go to my local restaurants here in Chicago, and as you see, Oliver, living here, prices have increased due to COVID. So the question is, as you see reopening, as you see more people come in, and get out and about, will those prices start to come back down? I don't see it happening. So I think those prices are there to stay. I also think there's some supply issue, obviously, with a number of different components and issues. You're seeing that with semiconductors. You're seeing that with some of the dynamics that go into the industrial trade. Those things have longer lead times. And so my view is, I've been saying for a while here, inflation's coming. I think it's here. I think the 10-year obviously is starting to wreak a little havoc, obviously, with some of the bond vigilantes due to that. And the question is, do we stabilize around, the 1.5% yield, or do we start to see a further steepening of the yield curve, and thus, stocks have more downside?
Is it possible, David, that there's this weird relationship now where the Fed has promised they're not going to hike until we get persistent inflation, and so the bond market's really running here? Is it possible that we should be viewing the hike potential as an economic deterrent, and thus if we do get an inflation print, does it become like this weird backwards, like sell the news and buy bonds at that point? How do we think about this new regime where the more Powell talks about not hiking, it's like the further the yield goes? It's like the opposite of what you think.
Well, I think at some point, as we keep saying before, with Livermore, our focus has been inflation. Our focus has been, does the Fed really have control of the yield curve? I don't think they're going to step out in that regard unless yields really start to get a much higher, right? So if you get to a 175, 180 on the yield for the 10-year, that's where potentially they can step in and try to, push that down back, right? And obviously be in the market. The question is, I don't think they're going to pull that rabbit out of the hat until you see a much further selling. And the real question is, if they start to see further inflation, further positive economic numbers like we saw today with the jobs front, at what point do they even want to step in, right? At some point, you got to just let the economy do what it's going to do, and you got to let the markets do what they're going to do. And I think ultimately, you're going to have to see that is the economy stable enough and strong enough to withstand higher rates or not? And that's the biggest question out there.
Yeah. All right. Now, in the meantime, the areas that are benefiting from this rotation the most, really energy and crude focused. You've talked with us about one of your energy plays, Jadestone, and looking at ways to get exposure. Is that the way you want to do it? Are there broader ways to get exposure to energy? Do you want to lever up more on that trade at this point, David?
Yeah, so to me, I think it's the same thing you and I have been talking about now for a few years, is that when you see this lack of investment in a sector, and that's why we've been overweight, obviously, energy for the last few years, it's not necessarily you want to own a basket of companies, because I think, as I've said, the sector is going to get smaller. You're going to see more consolidation. There's no capital really still in terms of financing for a lot of these companies. So the industry will continue to get smaller. And last time you and I talked, we talked about the curve in terms of the calendar spread with oil. So you're seeing, Brent front month almost $70 a barrel. And again, if you go out a year, go out 2 years, you're still seeing, prices that are down, $6, $7, $8. So that, again, it benefits those that are able to produce oil today and sell it. It doesn't benefit the guys with the vast acreage plays. So the paths used to be, I want to own shale, I want to own guys with all the acreage because of the potential, and they were able to fund it with equity and debt. Today, those markets are shut off, and they're continuing to be shut off. So the best companies to own would be like a Jadestone Energy, could be like an EOG in the US, and even some of the smaller cap companies that Livermore is focused on, because we see that they're underfollowed, under-researched, generate a lot of cash at this price deck, and the potential for consolidation and even a premium is there. So same goes for the state, a lot of these different commodities sectors. We look at oil, obviously, we're looking at gold, but as I told you, we're not looking at gold from the play of gold itself. We're looking at the miners. Some of these miners are trading at 2.5 times EBITDA, at $1,700 gold. We have to like that area to invest for a hedge fund. Same thing with obviously platinum and silver producers, same thing. So there's this theme that's really taking over now in terms of inflation, and Livermore is going to ride that for as long as we can. I see more opportunities, more path to invest even more capital.
What about
in
crude?
The space and pullbacks like you're seeing.
David, how high do you think crude can go
today? And I think there's a lot of running room.
WTI, we're breaking through. Just real quick, I want to get your thoughts. If you got a price target in mind, how far WTI can go? Well,
like I said, I pay more attention to global Brent, but I personally think WTI can get up close to that $70 band. That's a pretty good resistance level.
Okay.
The real question comes about, like I said, is inflation is a tax on the consumer, and so is oil prices, right, as it moves higher. So that shows you inflation is alive and well. And the real question is, given all the stimulus, given the stimulus that's going to come out, obviously in the market even this month, with another 1.9 trillion, how much higher can WTI climb? And potentially, I'm saying, if you look at another year and we see lack of investment catch up with the world, and more demand because of reopening and more demand because of more vaccines, I still think WTI has a chance of getting near $80 a barrel.
All right. Thanks for the update, David. Appreciate it. Mr. Neuhauser, Managing Director at Livermore Partners.